All right, good morning, guys. Today is Monday, June 24th, 2013. My name is Craig Hill, and as Todd indicated on Friday, he is out this week. He is going on vacation, and so he asked me to step in and just maybe go over some concepts with you guys. Some different trading concepts that I've learned from different mentors that I've actually applied to what I've learned from Todd. So, I thought I'd take this time, and what I'd like to do actually is go over a few things today, and then that kind of build up to the rest of the week. You kind of build upon. So what I'd like to do, guys, obviously there are some things in here that I'm going to indicate that may improve your trading, or actually just open your eyes up to slightly different viewpoint or different perspective in the market. So, and you can use it in conjunction with what you're doing. You can use it in conjunction with, the trading concepts methodology and what you've learned from Todd. So, and then maybe tomorrow we'll actually go over some live trades, some real trade setups. But trading it's all just a probabilities game. Pretty much, it's all based off supply and demand, and it's just a probabilities game. So what you need to do as a trader, what we need to do as traders, is stack the probabilities in our favor, and also the markets again are based off supply and demand, and you and I really aren't. I mean, all we can do is participate. We're not moving the market. We're not bidding the market up, offering it lower. We just don't have the financial resources. So to put the probabilities in our favor, we have to understand what the smart money is doing. We need to be able to recognize where the institutional buying and selling activity is taking place in the markets. And one way to do that, guys, is to approach the markets or approach your charts with a weight of evidence approach. And come up with a weight of evidence to solidify support or resistance or likely turning points in the market where institutions are participating, so you can trade with the smart money. So, and Todd has already taught you a few things. He talked about it the other day on Friday using Fibonacci Confluent zones. If you watched his video Friday morning, he had mentioned, I think it was on the yen trade, or it might have been the bonds trade, the TBT, Tango Bravo Tango trade, where he had drawn Fibonacci Confluence on there, and you saw the market pull right back into Fibonacci Confluence, and you got that, you got that bounce in there, that retracement, and a move back up to potentially retest the high. So it's pretty much the same concept. So you can use Fibonacci's, as from a weight of evidence approach, to identify likely turning points. But what I'd like for you to do is start looking at. Let me get to my charts here. Start looking at the price action itself. All right, guys. So what I'd like to do is just show you what I'm looking for in price and volume, and to help you identify where institutions, where that institutional buying or selling activity is taking place. And if you just start over here on this right edge and just look to the left, guys, what I'm looking for obviously are some volume spikes. I'm looking for spikes in volume. Okay, that indicates, like I mentioned earlier, it's going to take size. Institutions come in with size, and volume, indicates pretty much size. Conviction. When you have volume and you have the close near the low or high of the bar, I mean, you have sentiment there, and then when you have the volume behind it, that's confirming the move, more or less. And then here's one that really jumps out at you, not necessarily in the volume, but in the price action itself. But what I want to point out is when you have an extended range vertical bar, okay, look at your normal range in here, right around like 88 to 89, maybe $1, $1.25. Look at this bar here from 88.5 down to 86. Okay, that's about 2.5 points versus a buck and a quarter. Okay, that's twice, if not more, the size of your normal range. Okay, so this is what you're looking for: extended range vertical bars with volume spikes. Okay, and then now what you're looking for, what specifically, what price level are the high and low of the bar. Notice in here the market ended up holding as resistance in here. It broke up through it and it gapped down. Okay, it did take some volume to break up through it, but on the very next day we actually gapped down below it. But then look over here to the right. See how we held back in here? Okay, and then I just wiped out my I was wanting to show you. Notice when I draw the fibs up on there, this is what I'm talking about, a weight of evidence approach. When I draw the fibs up on there, notice how the high of this bar is in confluence with the 50, 62% fibs in here. So you can use your Fibonacci's. You got the MAs right there. You can use the price action as well, and you know, to help you identify and to give you that confidence that, hey, if the market pulls back in here, we should get a bounce in here. And when you look at the price action, sometimes you can actually almost pinpoint exactly where institutions are most likely to come into the markets, you know, in support of the current move. So, and then you know, if you know that if it breaks that level, then chances are it's a failure and we're going to see lower lows in this situation. So, and I'm going to go over something tomorrow using the ATR, the average true range, which I've got down here on my screen down in here. I'm going to show you that tomorrow, how you can use that and start implementing that in determining which time frame to trade off of in volatile markets, so as to, you know, minimize that risk or to maintain that risk that you normally trade with, and then also to use it to help you prevent whipsaws in a situation like this. Real quick, for example, you see in here that the average true range is at $1.35, okay, on ExxonMobil. So what you can do actually is, what I like to do is use a percentage of that, and that tells me precisely where my stop goes, and the majority of the time it works. So what I do is I try to pinpoint that level of support or resistance in here. This is a great example. Pinpoint that level of support or resistance, and you can see we've got confluence with 5062. We've pinpointed that support level right in here at this level, and you can use the ATR, percentage of the ATR, to tell you how far to place your stop down just below that level, you know, to stay out of the natural ebb and flow of the markets. So let's look to the left real quick here, and I'll show you. Here's another extended range vertical bar. You don't have a lot of volume on that, but anytime you get an extended range vertical bar, notice in here we actually ended up holding and support in here. You know, chances are you weren't getting short in there, especially after this move up. But you know, sometimes if you look to the left too, you can identify potential profit stoppers, price levels where profit, you know, if you're looking to take profits just above that, and if you can identify in the chart, hey, you know what, my trading plan says I need to take profits here, but the market's getting choppy. I've recognized this as major resistance. It's only 25 cents, 50 cents. You know, if you're trading the mini futures, it might be 2 or 3 ticks. You know, sometimes it's not worth fighting for that, and go ahead and take your profit right in there, and move on to the next trade. But at least this way, you've gotten, you know, this is putting the probabilities in your favor. So that's what you want to do as a trader. Here's another great example right here. We had volume coming in right in here, continuing to look to the left. See how we broke down out of this consolidation in here with this bar? If I draw a horizontal line, perfect. Textbook pullback right into resistance. Okay, this is supply. We had institutional selling activity taking place right in here. Okay, institutions jumped on this right in here, and then other retail traders came in and continued to offer the market lower, and then finally the bulls came back in. They pushed it right back to where the institutions previously participated in the markets, and notice we actually sold off and put in a lower low. Okay, if you draw your fibs from here, from this high down there, then you might actually, that might fall right. Yeah, that's right on the 62. So, here's a great example, another great example of using just the price action itself. Use extended range vertical bars with the price action itself and volume to help you, add to that weight of evidence that you're using, the Fibonacci's, the moving averages, the counter channel bands, or whatever you're using. I mean, this is just pure price action here. Extended range vertical bars and volume spikes, that's what you're looking for to help you identify where institutional buying and selling activity is taking place. And again, tomorrow what I'll do is I'll go over the average true range and show you how to use that to help you, prevent whipsaws, and or to help you know which time frame to trade off of, so as to keep your risk kind of within those same parameters. Because there's really, as volatility increases, especially now in the markets, as volatility increases, you can either reduce your position size or trade off of a different time frame. It's just a faster trade. So I'll show you guys that tomorrow. Hope this helps, and we'll see you guys tomorrow. Have a good day.